All right. Well, happy lunchtime, everyone. Hopefully everybody in the room's got a plate of cookies and lemonade. And those of you that are out there in virtual land, have something in front of you to munch on when we go through this today. Any of you that have joined us in the past, we've run through this with real estate professionals. This is anybody, whether you're a sales agent, a title agent, real estate attorney, a lender, anybody in that real estate spectrum should be able to get some takeaways from what we're going to talk about today. I'm Mike Twitty. I'm your Pinellas County property appraiser. We love doing these public education sessions. And obviously, we've got a lot more on virtually today than we do in-house, but we try to do these hybrid because it's nice to have a lot of bodies in the room. So we appreciate those that made the trip out. And we're going to run through a bunch of different topics. You'll see here, there's a lot of different things we can talk about. We won't necessarily go into all of these items today, but I'll touch on some of the ones that are, I think, more pertinent right now at where we are at this time of the year and what's going on right after the most recent closeout of the legislative session that ended last week. So there's been a couple of things that changed in the ad valorem space. So we'll start with a couple of key dates. So the items in bold here are ones that our office handles. The other ones are some other things that the public may not as be concerned with, but we're still involved in that process. Obviously, January 1 is always a critical date for what we do in the assessment world. So while you're used to working in most cases with as-is appraisals from the fee world that those have an as-is market value as of whatever that date. Typically, it's the date of inspection aligns with the date of report and the date of value. It's not always the case. You can still have retrospective or prospective valuations, but that's mostly what you're dealing with is an as-is value as of whatever that point in time is that an appraiser looked at that property. In the assessment space, it's different. Our effective date for all 436,000 parcels in our county is January 1. We're working on our values right now. Obviously, it's a lot of parcels and it's a lot to get our arms around with the size staff we have. So it takes us a while to get it all done. We'll finish our estimates by the end of this month. Those will end up going to the taxing authority so that they can have a heads up on their budgeting process. And then by July 1, we actually have to deliver that data and all those numbers with values and the exemptions to the Department of Revenue. So that's what's called our preliminary roll at that point in time. And then we work those values over the summer. And that's also the time when you can have informal meetings with property owners. The values will be published to the website, likely in the second week of July. So people can start looking before trim notices ever get sent out in August. So that's a great time for people to peruse the website, look up their property, see if everything looks okay, the exemptions look appropriate, like they have the right exemptions, and that their just value, assessed value, and taxable value makes sense to them. And if not, they can call us up and our appraisers will talk with them and walk them through it. So we can handle that well before. So if we find an anomaly, something we need to tweak before we get to trim time, we can deal with that. So you can see there's several different, our world has a lot of different dates and deadlines here throughout. But that January 1 is the biggie, and obviously March 1 is the deadline to timely file for a homestead exemption. So that would be somebody that, for example, the March 1 deadline this year would have been for those that bought in 2022. Because they would not be eligible to file for homestead in 2022 if they bought sometime during the year because they had already crossed January 1. So they would have had the benefit of the seller's homestead exemption and assessment cap if they were present. As we move along and you get into when we talked about the June and July dates, August is when we start getting into the trim notices. August 21st is when trim will go out this year. It's always basically that third week of August. The date moves slightly. September is when the taxing authorities start holding their formal budget hearings, and that's where they, by October, they finalize the millage rates. Remember, the equation is taxable value times millage rate equals ad valorem taxes. And if anybody has non-ad valorems, those are the ones that show up on the bottom of the trim notice. They're always a flat rate. And we've got one that moved from an ad valorem to, or non-ad valorem to an ad valorem, which is the Suncoast Fire. This was an ad valorem tax. And then in October, we deliver all of our roll to the tax collector, and then the tax collector creates the bills at the end of October. They basically go out between November. People start getting them that first week of November. And then the deadline to pay that is March 31st of the following year. But if you pay it in November, you get the 4% discount. That discount declines by 1% up until you get to March. That's kind of an overview of the timeline. Now, understanding our values, again, you're used to dealing typically with one value, and as is market value. Unfortunately, in our world, we have three values. Even though they're as of the same date, they're all as of that January 1 date, but there's three different values because there's different things going on. So just market value is basically our equivalent of market value that you're used to dealing with third-party appraisals. However, per the Department of Revenue and state statute, we're allowed to deduct up to 15% off of what the real street market value is as of January 1. So that's why you will typically see our numbers are below where NASA's market value would come in on a third-party appraisal, as of if you did it as of that exact same date. Now, assessed value, if you're a new buyer, you cross your first January 1, your assessed value and your just market value are going to be exactly the same. But now over time, if the market continues to rise, and say the market's rising at 10%, well, assessed value can't rise more than 3%, or the consumer price index, whichever is less. So the last few years, obviously, we've had CPI that's very high. It's been in the 7-8% range. So we've hit the 3% cap the last couple of years, and we were going to hit it again this year. So you start to build up a gap there, or a differential between just market and assessed value. And that's what we call, basically, that's your Save Our Homes benefit. And we'll get into that a little bit deeper here as we go forward. We'll talk about portability, all those things. But that is where that difference in that Save Our Homes benefit starts to build up. That gap between those two. So then the next value is taxable value, and that's when you take your exemptions away. So that's when you deduct your $50,000 homestead exemption, your $5,000 widower's exemption, those types of things. So that gets you all the way down to taxable value, and then the taxable value times the millage rate is the ad valorem tax amount. Let's look at values a little bit. Well, I always try to show this graph because it gives a historical perspective, which is always nice. So you can see the blue bars here are just market value. The gold are taxable. So the gap between those two is a function of your exemptions and your assessment caps. So that's that Save Our Homes cap kicking in, protecting the values in gold, as well as your exemptions. And that's what creates that difference. So this difference back in, I believe a decade ago, was only a couple of $1 billion. And now that gap is about $40 billion. So there's a lot of value protected under the Save Our Homes cap. But you can see this was the last peak back in 2007, and we have far surpassed that. This is the 2022 values. And obviously we're working on the 2023s at present. So just market value countywide, $185 billion overall, and we'll probably be in the $200 billion range for this year. But then taxable quite a bit less at 111 billion. New construction, we have that here on the bottom, and we can lay that on and read it off the right side. But so new construction's been running about $1 billion a year for the past several, and it's about that number this year too. I think it's going to end up probably being about $1.1 billion, $1.2 billion. So pretty steady here, which is pretty impressive for a county that's effectively built out. You know, Pinellas and Monroe County down in the Keys are really about the two counties that are fully built out. You pretty much have to take something down, put something up. You know, really minimal amounts of vacant land. So obviously some underutilized land. This still exists around the county, and you'll see a lot of that infill redevelopment is where we'll be adding new construction dollars in years to come. And if we break that new construction down from a taxable value perspective, you'll see about 43% of it is in residential. About a third is in rental multifamily. And then about a quarter is your other general commercial property types. You would have retail, industrial, self-storage, hotels, all that type of stuff would be at that 25% there. And then market activity wise, so this is just a snapshot of single family. And you can, I really like looking at this line here, where you can see the sale transaction count for single family. And you can see in 2021, we hit a record of about 16,700 single family transactions in Pinellas County. That transacted at a median sale price of $345. And that number again jumped up in 22, but you can see transaction volume fell off quite a bit, fell off back to in that 2015, 2016 type of sale pace, which would be a more normal year. And that's because we really we were still on fire the first half of 2022. Interest rates started to rise, and the market started to turn some, and then we started to see a slowdown in the back half of the year with those rising interest rates, and we saw transaction volume fall off. But we really didn't see, I mean, we did see some sales go, prices pull back a little bit, but overall, just median sale price in the county overall was basically the same as it was in 2021 at over 20%. These are the realtor stats here. So this is just from the last report in March. And actually, we do have updated, I didn't get that slide in here because there was the April report. So I apologize for that, but the numbers haven't changed that drastically. The month supply still in this around approaching 2 months range on single family. And this next slide that I'm going to show you, one I really like to look at. So this is extracted from the realtor data. And this is active listings of residential going back for the last decade. And you can really see, for a long time, we had approaching 8,000 active listings. That started to slide, and then it really started to slide during the pandemic. And actually, even before the pandemic, but coming into it, it was really starting to go down. And then the pandemic exacerbated that. A lot of people did not want to list their homes or move because there was a lot of uncertainty. So that really crunched and compressed supply. And you can see how it's turned here, and you can see the adding demand on here. So here's actual sale activity. And you can see why during this window of time here, that's why we had people paying 100% or better of ask. No inspections, immediate cash closing, all those types of things were going on. And it's because of that demand effectively outpacing supply in that time frame. And now you can see it's starting to return to a little bit more of a normal pattern. We did slip off that. You can see that slow down in the back half of the year in the transaction count, but then you can see it did start to go back up through for the first quarter. It was really in March that I started seeing the numbers start to move back up. This kind of paints that picture too. You can see 2021 condo transactions versus 2022. Again, that back half of the year is where they were tailing off. And if we look at single family, same type of thing, but quite dramatic, the amount of sales. Let's touch on Save Our Homes a little bit. Some people get confused on this. People often wonder why two homes very similar to one another, you know, same vintage, very, very similar. In some cases, they're literally could be cookie cutters of one another, same builder, built, you know, this at the same time. And it's all because of that Save Our Homes cap. You know, how long that owner has held that property, what other exemptions they may have as well. They can have other exemptions on top of that would even drive their taxable value even lower. But just here's a typical example in St. Pete of, you know, where you know, this homeowner is paying $767 and this was paying over $4,700. But you can see the difference in when they acquired their properties, 1993 versus 2020. So we have that, you know, that does create, you know, while Save Our Homes was created to protect longtime homeowners from getting driven out, because before that came in, we had a lot of out-of-market buyers coming in, paying cash, not needing appraisals, and they started to inflate the market at a exponential rate that really wouldn't have been sustainable for a lot of homeowners. Because if it was pure market, you just have to move value with what's happening with market activity, and you could literally get taxed out of your home. So that was really what the genesis of Save Our Homes was to help those people that, you know, had basically been taxpayers in this market area for a very, very long time. And then all of a sudden they felt they could get run out of their homes. So that was why it began. In our county, we're at about 64% homesteaders versus 36 non-homesteaders. That number's moved up about 1% every couple of years. When I started in office 6 years ago, that was, you know, in the neighborhood of 59 to 60%. So what a lot of people have even found, it's not necessarily all new buyers that are homesteading. Some of it is long-time non-homesteaders. It might have been a second home, and then they've finally given up their other homestead out of state in the last couple of years and realized the value of Florida homestead and decided, you know what, I'm going to homestead in Florida. We like it better down here. We're spending more time here. We'll let the other property go, or we'll make that our secondary house. So this is just telling a little bit more about the history of Save Our Homes. That was a constitutional amendment back in '92, and then it first took effect in the mid-90s. You know, it has a 3% cap. You may see next year, there actually was a bill this year to try and change that cap to 2%. Didn't make it through the legislature, but I suspect we'll see it come around again next session, because there's still plenty of time, because you can't bring constitutional amendments to the ballot until it's a general election, and the general election isn't until next year. So watch for that. That could be coming back around. This shows you just the history of the Save Our Homes cap over the last 13 years here. It's rarely broken the 3% cap. It's only hit it a few times. Really, it only hit it once over that time, except for the last 2 years. In most years, it's been CPI has been hanging, you know, plus or minus 2%. Yes.
On the last 2 years, when it hit the cap, but that's based on all the sales and everything that went on, correct?
No, not because of sales. That's because of the
Okay.
consumer price index
Thank
and
you.
because of inflation.
Thank you.
Yes.
Okay.
Yeah, that's what made it hit the cap, Because inflation was, 7-8% last couple of years. So obviously that's more than 3, so you're gonna hit the cap.
Okay.
Yes.
You mentioned that people can be homesteaded in a different state, and then they have a property in Florida, and you basically decided to have this one as their homestead.
Right,
But just for understanding, I know that if you declare that you're homesteaded, but you're not, then it's basically fraud against the government. But is
Right.
there any check that you guys do when it comes down to somebody that, say, lives in Michigan
right.
and all of a sudden says, I want to be homesteading in Florida?
Sure. Yeah, they have to meet our qualification for homestead, they have to own and occupy as of January 1. They have to have the indicia that proves that basically they're a Florida citizen. They need to show us their driver's license, their auto registration is here, things like that that would, sometimes it could even turn into a utility bill if there's really some other outliers to help prove that, they've been in that property and that is their primary residence.
And I don't know if you're gonna touch on this, but there was that change in residential permits that allows specific areas of St. Petersburg and I believe Clearwater to build another, to make basically a single family into a multifamily by adding a unit.
Right.
So how does that work from an homestead standpoint?
So in those cases, their homestead could get prorated. So we would look at the value, say, for example, say they turn a single family property into a 4-unit, but they're still residing on that property. We would look at the value, see where that matches up, see if they get their full 50,000 of homestead, because we'll talk about that, but homestead's a little tricky too. It's banded in two $25,000 bands. So a lot of people think it's automatically always $50,000, but it's not. So it can be a portion of that. So we would look at that value, but then any of that new construction that would come on would be what we would call over the cap. So that would get treated as new construction over and above, and they would not get homestead protection on there. So that portion would be treated as non-homestead property, it'd be subject to the 10% non-homestead cap, and then the portion that's homesteaded would be treated as homestead. So the way the cap works a little bit. So we talked about, obviously assessed value is constrained by 3% or CPI, whichever is less. You can see in this quick example here, they're just showing divide for 300,000, and that when you cross that first January 1, well, actually we value it at 300,000 as of a January 1. Say maybe you bought it for 325 or 350 or something like that. But we value it 300. The assessed value when you cross January 1, it resets because remember all the exemptions and caps come off from the prior owner. So that becomes 300 as well. Then the next year, we're just assuming that the value rises 5% in this example. So that goes to 315. The assessed value is capped at 3, or could be even less if CPI were less. But in this example, so we cap it at 3, that's 309. So right away, that Save Our Homes benefit is $6,000 after 1 year of ownership. So then over time, that starts to accrue. So you can see in this example, we've got the market value on an increased run over 7 years, and the assessed value capped at 3%. So you can see that gap is occurring. And there it is right there. So that difference between your just market value and your assessed value is your Save Our Homes benefit. And you can see by the year 7 in this example, it's about $44,000. And that would be also the amount that we would refer to as your port amount, or what you can port from one property to the next. So if 7 years later, this property owner decided to buy another property they intended to homestead, when they homestead that, then they would have a new just value. We revalue that property. Their assessed value would be exactly the same, but then we take this $44,000 and take that away from from their assessed value and lower that assessed value right out of the gate, so they would not be one and the same. So we'd be applying that save our home benefit to that property, and then you take away, then you also deduct their exemption. So then they also had the 50,000, and the 50,000 comes off there. So they end up with about, $94,000, starting out of the gate. They get that benefit from their prior ownership. So what we may start to see in some years going forward is something called the recapture rule. This happened during the Great Recession. A lot of properties rose in value rapidly. You can do it this way, so I'm on camera, the going correct, right? Rose rapidly, and then they started, we hit the tipping point, started to go down. Well, we were always behind in value as we rode up. Then when the worm turns and market value is going down, we can be behind that because the data hasn't caught up yet, and because we're always on that January 1. So if things are sliding like in the back half of the year and you're valued in the front half of the year, even though we have a January 1, you're not getting your trim notice until August. So it's 8 months later after that point. But what can happen, a lot of people in the Great Recession were confused because their just market value was falling. Like this up, see a little better. So in this case, their value was falling. However, their assessed value, which they had a big cap, they were protected by a lot of cap there. So they continued to rise because until the two meet, it cannot start to go back down again. So the assessed value, this is what's called the recapture rule, will continue to rise at the 3% or the 10% on homestead until those two meet. And then they can go down together. And then you would establish a new base for your cap once the value started going up again. That make sense?
Does.
Okay. So the 10% cap. So this applies to everything else that's not homestead. Doesn't matter what the property type is. Vacant land, motel, single family house, second home, third home, whatever. Doesn't matter what it is. So that 10% cap applies to all other that is not homestead. The difference there is the 10% cap applies to all millages except for school villages. So you have a state school and a local school millage line. If you look at your tax bills closely, where the millage lines are broken down, you can see that in our tax estimator too. If you open up, you see all the various villages and you see the exemptions applied to each. If you look at schools, you'll notice like even a full homestead exemption doesn't apply. Homestead exemption, only the first 25 counts against schools. The second 25, you do not get a deduction for school villages. And the 10% cap works the same way. So some people have been confused. They think, well, my taxes can't go up more than 10%. Well, if the market went up more than 10% and you're non-homesteader, even though you hit the 10, you're at the 10% cap, you capped all other villages. So those all moved 10%, but school villages weren't capped. They go to just market. So that could push your tax bill actually over the 10%. All right, here we go. Portability, everybody's favorite. So we've talked about what it actually is, what it creates. It's that differential between just market and assessed value. So that is the amount that you can port. However, there still are limitations on that. So you have a specific time window that you can do that. Used to be 2 years. I was successful working with the legislature to get a constitutional amendment on the ballot, and we voted for that in 2020 and increased portability to 3 years. So it used to be 2 tax years. And the reason I thought it was so important to change that is so many people were getting caught off guard, because 2 tax years is not the same as 2 years from when you sell your property. So The only time you really got 2 tax years is if you sold at the very beginning of the year. If you sold at the end of the year, then you already burned your first tax year. So now you only had 1 year to replace that property and still be eligible to keep your portability. So many people did not understand that. They were calculating from when they sold and they were coming up short. And it was really hard when people were literally could be weeks or days away and lost the report. And some of the reports were pretty substantial. So I thought it was really important to add that 3rd year, and it ended up working out really well. We didn't know we were going to head into a pandemic and other things where supply was so tight. Even if you sold your property, you might not be able to find a replacement in the time. And then if you were building a house, that's another issue. You know, people couldn't do no new construction. They would literally have to hold on to their prior house all the way through. And a lot of people like to sell, put a deposit down, then rent, and then move into the new home. And with a 3-year, you can orchestrate that much more effectively. So there are a lot of reasons for it. You know, you have people that go through financial difficulties. You might have a disposition of a marriage. Different things happen that people just need that little bit bigger of a time window. And it was a sad thing to see them lose that. So we were successful in getting that across the goal line. The deadline to apply is the same as for homestead. So you apply for port at the same time as your homestead application as for March 1st. Now, the limitation on the amount that you can port. So there's a maximum port amount of $500,000. So that's the max you can carry forward. And that's assuming that the just value on your prior home is equal to the just value on your new home, or your new home is worth more. So it needs to be greater than or equal to, in order to get up to basically get the full amount with a maximum of 500,000.
But Mike, if it's below, you'll get a percentage of it?
Yeah, that's what. So if the downside, if you downsize and your just value goes down, then that's prorated down. So if you're in a home that we valued for 500,000 and now you moved into a condo that's at 250 and you had $100,000 in port, well, you're gonna get 50. It's just a prorated amount down. And the great thing is you can do all that in the tax estimator and you don't have to do any fancy or fuzzy math. So I
Love it.
encourage you to run it there. Very helpful, and it's really neat. I'll try to show you if we have time. You can actually do some different purchase scenarios in the tax estimator, because you don't have to actually put a hard address in. If you said, I've got a client that wants, to pay $500,000 in Largo or $500,000 in St. Pete, and you can run both those scenarios because you're just picking the millage for that city. That there's a little drop down there to do that. You can run both of those and you can see what the tax difference would be.
Did not know that.
I'll show you where you can do that in a little bit. So portability, this is just showing you a little spiral here. So that's what portability used to be, that 2 years, and these are tax years. So when you calculate it, so if we sold in July, you would need to roll back to the beginning of the year to do that 2-year calculation. So that's the way I always think about it. Wherever you sell and it's in a year, go back to January 1, do the math for 2 years. And by the end of that 2 years, they need to own and occupy a house for to qualify. But now we have that extra 3rd year, which made a world of difference. Because what it does is, even if you sell it at the end of the year, you'll always have a minimum of 2 years. So that's kind of the worst case scenario. That was my rationale when I went to the legislature and I said, let's just add a year, because there was so much confusion. People were voting on this. They thought it was 2 years from sale. They didn't realize it was 2 tax years. And this would restore that and give them, even in that worst case scenario, that 2 years they thought they were originally voting. Exemptions. We all know why you should apply. And I know the realtors that are on the call today and in the room harp on their clients to make sure you file for homestead, make sure, and still, unfortunately, some don't. They always have up until that March 1 in the year after their purchase. We will allow late files into mid-September, but we've got to draw the line somewhere, and that's our absolute deadline is before we start going into the B&E process. So we encourage people to try and make sure you get your applications in as soon as possible. If they cross the March 1, there's an extenuating circumstances form on our website that they can fill out to accompany their application. And there's a plethora of other exemptions that they can potentially apply for. Many of them do have low income requirements, so it's important to go check those out. But those are all published on our website, and you can always call our office, talk to someone in our exemptions department, and they'll help guide you through that. So we'll touch real quickly on this because people do get confused about how that homestead banding works. So we talked about homestead exemption is 50,000. It's 25, first band is 25,000 on $0 to $25,000 of value. So that was very simple. Applies to all millages. First 25,000 completely exempt taxes. When you get to the second band of 25, that is not exempt from homestead, that gray area there. So in that value range, there's no exemptions. And when you hit the 50 to 75,000 of assessed value, that's that second $25,000 band. And that is the one that applies to all millages except schools. And then above that, there's no more exemptions. So let's talk about some of the stuff that just happened. And what happened at the end of last year, because this is actually effective for 2023. So the widower's exemption is historically, since the late 60s, been $500,000 of assessed value. That unfortunately only equated to about $10 in taxes. So not a very big number. It was already stated in the Constitution that it could be increased up to 5,000. We've tried for many years to get that moved as with all of the property appraisers, and it had been unsuccessful. We did get it moved last year as part of the tax package. So we were able to get it all the way to the maximum of 5,000. So we increased it, tenfold there. So now that $10 tax break is basically a $100 tax break for those property owners that fall in that category. Yes,
For those who already have it, will that automatically be applied,
it will.
correct?
Yep. So anybody that had it prior to 2023, it automatically rolls over for this year. And they'll see a much nicer savings on that. The other thing was that passed was related to an abatement of taxes. This was a function of the catastrophic collapse down in South Florida. So, but that if you have that type of a catastrophic event, they would be eligible for an abatement of taxes for the amount of days that the dwelling was uninhabitable.
That also affect the inn and Fort Myers.
So what they do, what the legislature typically does whenever there's a hurricane event, during session, they'll provide that similar type of relief, but they'll name those storms.
Okay.
So they'll say, okay, this storm qualifies. So every year, if there are storms that cause that type of damage, they name those. So the condo safety legislation. So this is a hot topic around the state, and obviously Pinellas has a lot of them that would fall in this category. So this has created a milestone inspection process, and everybody needs to have their inspections done prior to the end of 2024. So condo associations are scrambling, trying to line up inspectors. It requires a licensed architect or engineer to perform these. It's basically a two-step process. The first phase is a visual inspection, determine if there's any substantial structural deterioration. And the time frame is buildings that are 30 years of age or older, or 25 years of age if they're within 3 miles of the coastline. And then every 10 years after that. So if you get the visual done and everything comes back okay, and you don't have any structural integrity issues, then everything's good and you have another 10 years. If they determine that they need to go to the next level, then that's where it can start to get very expensive. Because now they're gonna come up with repair estimates. You're likely gonna have to raise your reserve amounts and your maintenance fees. And there could be obviously a large special assessment could kick in. We've heard already about special assessments in the $50,000 to $200,000 range around town. So as soon as I saw this bill even getting breathed about a couple of years ago, I said, oh boy, condo living is gonna get a lot more expensive. Now, if you're in a well-managed and well-maintained development, you'll probably preserve your value and everything will be just fine. It's the ones that are more questionable. And, you know, we're skimping on reserves, you know, not fully funding. Those are the ones that have a higher risk of having some, I'll call it recalibration of their values. So we'll be watching that closely. So we'll be monitoring the condominiums and obviously their sale activity and communicating with the associations. Typically, they'll reach out to us if they're having major maintenance issues, because then we will make appropriate adjustments to our valuations as well. So this, a very large affordable housing package passed. It was the very first bill to be signed by the governor, was a Senate President priority. And it really has three key points to it, providing additional affordable housing exemptions within the state of Florida. So the first one is related to nonprofit held land that's leased to for-profits for a minimum of 99 years. They would, for extremely low to moderate income housing, they would be eligible to have the land treated as exempt property. The second item within there is newly constructed by a for-profit or nonprofit multifamily entity that is certified by the Florida Housing and Finance Corporation and meets the household income limitations as shown there. So basically, if it's 80 to 120% of AMI, it's a 75% exemption on those units. And if you're below the 80%, actually, it's technically greater than 80 to 120 is 75% exempt. I know they wrote that really weird. And then up to 80 is a 100% exemption. So those are income driven, obviously. The project needs to have more than 70 units. And they can't double dip, so they can't already be basically a tax credit project and do this as well. And then you have a third leg of the stool there that will be a local option. So your county or your municipalities can adopt whether they want this exemption to apply within their jurisdiction. And this would be for existing multifamily that may have a tenant profile that meets with the 0 to 60% of median AMI, essentially, to qualify. And that would be projects of 50 or more units offering at least 20% affordable housing. So a lot of moving parts to that one. So that one's going to be really fun for us to administer next year, but we'll be watching because that won't kick in until 2024.
Number 3.
Yes, actually, all of those
Oh.
will. So the way that usually works is the governor usually makes them effective by July 1. He has to sign them all before then, or they'll automatically go into law if he doesn't veto them on that July 1 date. But then that they're already past the January 1, our magic January 1 date. So it really wouldn't apply to what we do until the next year. I'm not going to spend the house tax package had a lot of moving parts to it. The pieces that would be most interesting to those in the real estate arena would be, many of you may have learned that just in the last couple of years, if you are already 100% TNP disabled veteran and you are basically completely tax exempt and you move from one homestead to the next, You used to have to pay the full prorated amount on the new purchase, at sale, you pay the prorated taxes at closing, and you still do. However, in the following year, as long as you apply for homestead on that new one, then you can apply for a credit back from the tax collector. So the tax collector would essentially refund you that prorated amount that you paid in the prior year. That used to only work if you were already a homesteader, moving from one property to the next. The law was just changed so that now you could be a first-time disabled vet buying a home, still be eligible for the prorated refund, or you could be a veteran moving from out of state. So if you're 100% TMP moving from out of state into Florida, but you already, as of that January 1, you already had all your paperwork that said, you legally qualified with the VA, then you would still be eligible for that prorated refund as well. So that's pretty significant change there. They also opened up the definition for first responder to include federal law enforcement officers. This really stemmed from some FBI agents that they lived in Florida, they were Florida homesteaders, and they had to serve a warrant on a fugitive in South Florida, and unfortunately they were killed. And their spouses were not eligible to receive the first responder benefit because that's only for state first responders. So, state, police, fire. So that has been opened up to include federal as long as they're already a Florida homesteader. So they can't just be somebody that died in the line of duty in another state and then move into Florida. Their surviving spouse needs to be here. Those are the biggies that would apply to what you all do. This was a bill we tried to get across the goal line this year, and there may be a special session in September. I actually talked to two House reps yesterday, and they both are still fired up about trying to get this moving even this year if we have a special session. So this would have been as you all know, when your new buyer buys from a longtime homesteader, they get that big sticker shock when they roll across that first January 1. Now, I know everybody in the room in front of me is great at educating their clients. They know it's coming. But unfortunately, and the people that don't necessarily come to these types of things may not always advise their clients as well as they could, keep it that way. And what we found in just doing a lot of surveys with brokers and agents say, I love the tax estimator. I love running it. Takes that heat off of us. We show them this is just how it works in Florida. This is Florida law. A lot of them are coming from out of state or they're first time buyer, or they may have been, lived here a long time, but have never seen the true impact of a big gap in the Save Our Homes cap, because it didn't exist like that before when they transacted on the property. So a lot of them are in for a big shock if you all don't educate them on that. And so this bill was basically to approach the online listing platforms, your Zillow, your Realtor.com, and just first of all, it was take seller's taxes off, because it means absolutely nothing in Florida. It can be 1/10 of what they're. So that we just saw that as deceptive. And then you have the larger platforms actually will have a buyer's payment calculator, saying what your payment's going to be at this price. Well, some of those were just completely wrong. They're plugging in the seller's taxes in that payment estimator. And the good lenders are qualifying people on what their taxes are going to be, not necessarily what the seller's taxes are going to be. And you can do it the other way, but you're running into much greater default risk. The underwriters and the people actually loaning the money, they're not really happy about, lending on that type of risk. And you also want to serve your clients well. You want returning customers and clients, the people that may be moving into town, well, they've got other friends and family and that all need to be served and need somebody to be their realtor. So it's important, I think, to do it right. And this is basically just trying to add that layer of transparency, kind of clean up what's being presented to the public. So we've actually already have some amendments. I've already talked to, with the Florida Association of Realtors on this a few times. So I think we can get to a good place with it. We just couldn't get it across the goal line during the main session this year.
I have them sign the estimator.
Yeah.
Here we go. There it is.
So when they say, you didn't tell me.
Yeah.
Yep, that's smart. Let's see. All right, we're almost up to our hour, so
Oh, wow.
we got a boogie. Time flies, right? So a couple of quick things. You guys already know, must own and occupy by January 1, qualify for homestead, apply by March 1. A married couple is only eligible for one homestead, so be careful if you've got, two couples, they both have homes, they're gonna buy another home together or whatever. Tell them, remember, you gotta get rid of one of those homesteads or they're moving in together. We hate to lien people, but unfortunately it's part of our duties. So we do have to do that when we run across those, but we try to, when we find out in advance, we try to let them know. Another thing, if you have homesteaders and somebody gives them advice to put their homestead into an LLC, tell them not to do that. That is a bad thing that is going to reset their cap.
Call you on how to word it.
No, not if they're going to an LLC, just don't do that.
Oh,
So
okay.
trust, yes.
Trust, okay. thank
Yes,
you.
but LLC is a corporation, so, even though they'll, make the argument, well, but I get the same federal tax treatment, it flows straight through to me personally, I'm the sole managing member, it is still it's a legal change of ownership, or else it wouldn't exist. There'd be no reason for it if it wasn't really a legal change of ownership, because people use it to limit liability, so there's a reason for that. However, it can be a problem with the Florida homestead.
Well, sometimes they also do it because LLC in the end is a business, so they maybe want to use the 1040 exchange in the
Correct.
future.
Yes,
So that would be.
and I know people that 1031 exchanged into their primary residence, but they can't homestead it because it's in an LLC. But they understand and they just say, well, that's just the way it is. And then if I sell that and move to another, I can still do a 1031 exchange.
Mhm.
So you got to pick your poison there.
Right.
And then also something a lot of people don't realize. So you're a non-homesteader, you're subject to the 10% cap, and you've owned that property for several years. Well, market's been really hot. You're actually receiving some cap benefit. Then you decide, you come to our office and say, hey, I'd like to apply for homestead. Well, the cap resets. So the cap resets on that change, because now you're going from a secondary residence to a primary residence and switch over to homestead status, that cap resets. So we've run into a lot of those where we've actually advised them to unwind it. If it's in the same year, we do an analysis form, we look at it and realize, it might be 5 years before it's going to make sense for you to homestead because you're getting so much protection from the 10% cap. So just something to think about. Just one more of those many things to think about, like you don't have enough already. Another thing that I always advise people, try to understand what the seller's intentions are. We're seeing this more and more, especially when the pandemic was going on, because a lot of people were buying their replacement house before they sold their last house because they didn't know. They were afraid to sell and then they couldn't find a replacement. So they might, for example, say they bought a house in 2022. They sell their primary residence in 2023, the first part of the year before March 1. On the listing, it says that it's homesteaded. On our website, obviously, it says it's homesteaded, all those things. And then after that, they sell that one in 2023. They strip the homestead off for 2023 and apply for homestead on the property that they bought in 2022. And they totally do that up to March 1. We have no legal course of action to stop that. Now, if they late file after the March 1, we'll deny it, because now you're in that late file window and we typically know what they're trying to do. it's kind of a, kind of dirty pool. Because now you're really penalizing that new buyer, because now the prorations get thrown off, because now they reset it back rather than the next January 1. So that's why I say, try to understand what your seller's doing. Like, if you're representing a buyer, where's the seller going? Are they staying in Florida? Are they buying another house? Are they gonna rent? You can ask a few questions and kind of figure it out without having to get in the weeds on it. But understanding those intentions will really help protect your client. Yes.
So they bought their house, I'm just trying to think, they bought their house in 2022 at the end. And they're still in this house
Because they're selling it.
because they're selling it. And then they move and they take it off, but weren't they supposed to be in the house they bought in 2022, January 1?
Right. Yes, and they can claim that they were. It can be it can be hard to say that they weren't already moved into that new house that they bought. It could be in a different county. And a lot of times what happens is it is a different county. So, and if it's in that different county, that county will approve that homestead, and then we're forced to remove the one in our county, because you can't have two.
I have a quick question, and I don't know if it's an exception. Sometimes I work with elderly homeowners, and in a couple of instances, I had a situation in which the couple had bought the property a long, long time ago. So they had a wonderful tax rate, right?
Right.
So what happened is one of the two spouses goes into like long-term homes because of maybe sick or whatever.
Right.
How does that affect the 500,000 exception?
Well, if their intent is to return, we have a lot of elderly that go into an ALF, sometimes a nursing home. And as long as their intent is to return back to that house, unfortunately, we know some of them don't make it back. But some of them do. So we do not touch that homestead
Okay.
until we know what the status of that person, until they pass away or, we leave that homestead intact.
Okay, that's good. Thank you.
We're basically out of time, but we want to have some time for some questions too. So I just wanted to show you on the tax estimator real quick. Instead of putting an address up here, you can just drop this down. Well, it doesn't work on here because it's just an image. You shouldn't be clicking on it. My finger got a little happy. So you can right there, drop that down and pick your city. And it'll show that municipal line, and you can do that little comparison. So you could run a version there, and then you could run another one. And all you're doing on it is value, because it doesn't really matter what the specific street address is. Now that matters if you're going to get into portability and stuff like that. That's where that matters. But if you just want to compare a new purchase here versus there, you can do that there. I want to make sure you guys saw that. Next month, Kyle, we're doing website, right?
I think it was first time homeowners.
We're doing first homeowners next?
Ad for that.
Okay.
Ad for that website.
But anyway, obviously, we do have the new website at ccpao.gov. We encourage you to be driving that. We're going to be sunsetting.org very soon, putting some polishing touches on it. So they are running in parallel at the moment, but so much more you can do on the .gov site. It's got comp sales. It's got my location tool. Just really neat stuff that you can do on this my location button. For example, you can pull up in somebody's driveway, you touch that button, and it will pull up a short list of the parcels you're sitting nearest to, and you touch, usually it's the one on top is where you actually are. You hit that and it pulls up the parcel detail right there. So you don't enter any information, but obviously it's front and center, the search now. You got speed buttons here on the side to jump to the tax estimator and a bunch of other resources, apply for homestead, you got county stats, all kinds of things up here, and learn about how do I, most of your general questions, you can go into how do I, and it'll direct you and it'll take you right to that area of the site. You've got a website search right here, so you can put keywords in and hit the topics. I was just telling one of the ladies in the audience before we started, there's a new trust document, kind of a handout that deals with putting property into a trust or a land trust. and gives you some nice guidelines, and then also tells you, you can reach out to our in-house counsel at any time and vet that language. So you can shoot in the trust language in advance and make sure that, we give it a thumbs up before you record it. So those types of things, those are just services we like to provide because it just makes our job easier down the road. And we like when people don't have to do things twice. Or get a unkind financial surprise as a result of doing something, that isn't quite appropriate for what they're really trying to accomplish. So I encourage you to drive the site. There's a feedback button on there, and then also, there are resources on our YouTube site where you can watch prior videos that have health tips on the website, as well as our past public education sessions. We've got the buyer and seller fact sheets out there on the new website. And as you know, every month we try to do a public education session and we switch them up. This was real estate professionals. Next month is going to be first time Florida home buyers, but it really is for anybody that owns a home that wants to know more about how Save Our Homes and Florida tax law works, all of those things. We're on social media as well, so you can sign up there. We have 3 different newsletters that you can register for, and we shoot those out timely, typically on a monthly basis. For one is direct to homeowners, one for real estate pros, and one for business owners. And there's just a snapshot of some of the public education sessions that we do, and we're always trying to add new programs, new things of interest into that curriculum. The property fraud alert service, this is a service actually offered by the clerk. You probably hear a lot, you've heard more and more in the media about people losing their homes to deed fraud. Our seniors with a lot of equity in their home are really the biggest targets. So, I encourage you to share this with your clients. Fidelis is one of, I think, only about 30 clerks in the state that currently offer this service. However, it was just passed this legislative session that all clerks are going to have for this service. So that is the new law awaiting the governor's signature. So that is good for all Floridians. And this is a free service. You do not like the pay services. It takes less than a minute to register. You just go to the site, you enter, you type your name, you put in your email address, and anything that flows through official records with your name on it, you'll get an email with a hyperlink to that OR booking page, and you can check it out and make sure that it is not fraud.
It's like next day, because we did
Okay.
that and we did a roof.
Yep. And you saw the roof permit?
Yep,
Or the notice of commencement?
the notice of commencement,
Yep.
yep.
Yeah, I've had things come through. I've totally forgot, that it would even trigger on there, and I get an email. Oh, wait. I'm like, oh, that is me. Satisfaction of mortgage, a new mortgage, any of those types of things. So it's a great tool, just to keep tabs on things. You can keep tabs on your contractor, make sure they're filing their notice of commencement too. So with that, I'm gonna wrap up and see if anybody has any other questions. Do you have anything, online, Kyle? No chat questions? Okay. I know we went kind of fast there at the end and we jumped through a lot of stuff, but we had great questions in the room. And I hope everybody online and those here got some nuggets to take away.
Are you sharing the presentation?
Sure.
Or is there any way?
Yes, anybody that would like, we can distribute the presentation as
That
well.
would be.
Yeah, 'cause my things are always good, so.
Yeah.
Yay.
Thank you, guys.
Rather than